Asset misappropriation involving cash receipts is one of the most common forms of occupational fraud and occurs when employees steal incoming cash before or after it is recorded in an organization's accounting system. Because cash is highly liquid and easily transferable, it presents significant opportunities for fraud. The CFE classifies cash receipt schemes into three primary categories: skimming, cash larceny, and theft of cash on hand. These schemes differ primarily in the timing of the theft and whether the transaction has been recorded in the accounting records. Fraud examiners must understand how cash moves through an organization, identify weaknesses in receipt processes, and evaluate internal controls designed to safeguard cash assets from misappropriation. Skimming is the theft of cash before it is recorded in the accounting system, making it an off-book fraud that can be particularly difficult to detect. Because the stolen funds never enter the accounting records, there is often no immediate discrepancy between recorded transactions and available documentation. Common skimming schemes include unrecorded sales, understated sales, and theft of customer payments. Employees may fail to issue receipts, alter sales records, or divert incoming checks before processing. Detection frequently relies on indirect evidence, such as inventory shortages, declining profit margins, customer complaints, or inconsistencies between operational activity and reported revenue. Strong segregation of duties and monitoring procedures are critical deterrents. Preventing and detecting skimming schemes requires effective internal controls over the receipt process. Organizations should separate responsibilities for receiving cash, recording transactions, reconciling accounts, and making bank deposits. Mail receipts should be opened by independent personnel. Checks should be immediately, restrictively endorsed, and detailed logs of incoming payments should be maintained. Independent reconciliations of deposits, customer accounts, and accounting records can help identify irregularities. Management should also implement physical safeguards, surveillance systems, and periodic reviews of cash handling activities. Since skimming occurs outside the accounting records, traditional reconciliations alone may not reveal the fraud, making preventive controls and independent verification particularly important in reducing skimming risks. Cash larceny differs from skimming because the theft occurs after the cash has already been recorded in the accounting system. Since the transaction has been documented, the perpetrator must conceal the resulting shortage to avoid detection. Cash larceny schemes may involve stealing money from cash registers, incoming receipts, daily deposits, or customer payments after recording. Fraudsters often manipulate supporting records, alter deposit slips, create false reconciliations, or use lapping techniques to conceal shortages. Lapping occurs when stolen receipts are replaced with subsequent collections, creating a rolling concealment scheme. Because cash larceny leaves accounting discrepancies, it is generally easier to detect than skimming through reconciliations, audits, and independent reviews. One common form of cash larceny involves theft from company deposits. Employees responsible for preparing deposits may remove cash before funds reach the bank and then falsify deposit documentation to conceal the shortage. Some perpetrators alter validated deposit slips or classify missing funds as deposits in transit on bank reconciliations. Others use subsequent deposits to cover prior thefts temporarily. Effective controls include prompt deposit of receipts, independent comparison of deposit records to bank confirmations, dual custody during deposit preparation, and segregation of deposit and reconciliation duties. Fraud examiners frequently analyze bank reconciliations, deposit timing, and supporting documentation to identify unusual patterns that may indicate deposit theft schemes. Theft of cash on hand involves stealing currency maintained in cash registers, petty cash funds, safes, vaults, or other physical storage locations. Because these funds are immediately accessible, weak physical controls significantly increase fraud risk. Employees may remove cash directly, falsify petty cash vouchers, manipulate cash counts, or exploit inadequate supervision. Prevention requires strong physical security measures, restricted access to cash storage areas, surprise cash counts, independent reconciliations, and clear accountability for custodianship. Management should establish policies governing cash handling and require documentation for all disbursements and transfers. By combining physical safeguards, segregation of duties, monitoring procedures, and periodic audits, organizations can substantially reduce the risk of cash receipt misappropriation schemes.